Okay, Jason, I'm going to turn it over to you. We've got a few more minutes to wait for people to log in, but we'll go ahead and get started so we don't run out of time. But go ahead, Jason.
Thank you very much. Hello, everybody. First, want to thank you for everything everyone has done throughout their careers. It's always nice to be able to present in front of anybody who's in any type of service, but specifically, I have some close ties, several firefighters in my family, etc. So happy to be able to join. Um, I've known Mike quite a while. I guess I'll briefly introduce myself. I don't know how much of that was done, Mike, but I've known him and his family for almost 20 years, helping them and their extended family, for that matter, multiple generations over the years. I'm a director for Merrill Lynch. I have been for 23 years myself, and we these institutions, individuals with their financial planning, their retirement planning, et cetera. But Mike had asked me, and again, I'm honored to be able to share our most recent update as your guest speaker today. Again, you got me on that one, Mike. It's being recorded, so that threw me off a little. You guys could use this against me, but in all seriousness, I'll touch on some highlights. You were sent a very large deck. I've condensed that deck, and I won't necessarily follow along with it 100%. But we're just going to touch on 2024 if there's time. Again, Mike, how long do I have again? Sorry.
Well, 15, 20 minutes.
Yeah. So if there is time for a little bit of Q&A, I'll be willing to do that. And then you'll just have to cut me off, Mike. Okay.
Yeah. I didn't introduce you. It's Jason Trichler, Wealth Management Advisor and founder of the Trichler Wealth Management Group with Merrill Lynch. Is that right, Jason?
That's part of it. Yeah, I got a few more titles, but that sums it up. Senior director, executive vice president, some other things. But the root of it is I've been doing this pretty much all my adult life. I started out, I'll give you a little bit more background. I'm born and raised in Seattle, went to the University of Washington. I don't know who else was born around here, but I went to Franklin High School, McClure Middle School. My roots go back in the Seattle area, 3 generations actually. But yeah, so I'm going to share my screen, my shortened version of this deck here in a second, and just bear with me, get that started. All right, am I good? Can you see that?
You're good. I can see half of the page, so.
I have a very large screen, about 36 inches. So can anybody else? It's perfect full screen on mine. That's why I always check when I'm delivering an audience. Can anybody else chime in on that?
Well, at the bottom of what we can see, it says are not deposits, not FDIC insured.
That's the whole page.
Okay.
So right. We're good. That's the disclaimers I have to make on any presentation. Whenever you're talking about investments, they are not insured, guaranteed, et cetera, et cetera. But I think with this audience, there's enough experience to know that we can skip past that. So we'll go into the foundational year. Again, I'm on 2 huge monitors, so I know if you're on smaller laptops, just refer to the deck that was sent. And I did send out this shortened deck to Mike. If he wants to send that out again, that's okay. This is all approved for this particular presentation. The last few years, needless to say, have been unpredictable. COVID hit. Obviously, we all had our own experience with that individually and as a collective group. The main thing was they threw a lot of money, good, bad, or indifferent. Again, I don't want this to get political in any way. I tend to try and stay right down the middle at a problem. And that did save the economy, at least in the short term. But we had a little bit of a hangover in 2022. We had a lot of excess dollars floating around in the system. Of course, we had supply goods, the supply chain and goods in scarcity. That's the classic definition of inflation. Ton of money chasing after very few goods. So 2022 was a bit of a reset, which is why many of us, not all of us, but saw our retirement accounts, et cetera. If you're on a pension, it's great, by the way. I call that the gift, like the group here, that keeps on giving. That's the awesome part about pensions. But as far as your deferred contributions and your own investments, 2022 was a bit of a reset. Then we have 2023, a bit of a bounce back. People anticipating, okay, the worst is behind us. Everybody was picking a recession in 2023. Everybody, including us, by the way. Mild recession. We placed about a 70% chance of that. As the year progressed, employment numbers remained strong. The Fed continued to hike rates. Both, we thought, would eventually slow down the economy to a point where they could stop cutting rates, which that part was true. But we did think it would cause a little bit more damage amongst, again, 90% of the people in my industry to the economy itself. As resilient as it was, mortgage rates almost got to 8%. There's still a few outliers, which I'll touch here in a bit, but it was pretty amazing how resilient the economy was. But there was a lot of pent-up demand, and there was still a record amount of savings. Just by context, the average savings rate for an American is about 4%. We were up to 21% at the height of the stimulus, is what I'll call it for this particular setting. We're now back down to around 6%, still slightly higher, but there was a lot of money to spend. So even if people were living at home or unemployed and things of that nature, people were still, I mean, every time I went out to eat, it was like crowded, you know, once the COVID things had settled, obviously. So a lot of pent-up demand. The economy remained very strong. So here we go, 2024. What are we calling this? We're calling this a foundational year. Things getting back to quote unquote normal. I would say that there's never normal, but more importantly, things getting back to predictable is a tough word as well in my business because you can never predict the future. Just a more normal semblance of supply chains. Again, there's some outliers, which I'll touch on in a bit. But in it, it's going to be an area. I digress. But one interesting thing that happened was it was the first time in history, 170 years, in fact, that U.S. government bonds were down 2 years in a row. So that was 22 and slightly last year. So that was an outlier. It used to be you have your stocks, you have your bonds, you got a nice mix, one offsets the other. 2022, stocks were down 20% and bonds were down 15%. That's never happened before. So there was a lot of people thinking that a traditional stock and bond portfolio was dead. We're saying, no, that's not true. That was an aberration because of COVID and the dislocations and the second fastest rate hike cycle in the history of the Fed.
Hey, Jason, if you're looking to, are you still on the chart book page?
Yep.
Okay, sorry, go ahead.
I'll move as we get there.
Okay.
Thank you.
Sorry.
Again, this is my entryway here. So getting to that, there's my segue. 2024. Here's the foundational elements. Asset allocation will help finally portfolio returns. I'll start at the top and go to the right. Economic growth, inflation, and interest rates should start to normalize to a more traditional level. Corporate profit margin staying solid. Earnings growth likely remains positive, although less. We were at about an 8% earnings growth. We think we're going to be at about a 3 to 4%. The US dollar, as rates come down, we did not expect the Fed to hike in March like a lot of people did. They did not. There was a bad inflation number yesterday, which is why the market was down quite a bit. But we do expect them to start cutting rates in June, and that will, by default, weaken the US dollar. There's pros and cons of that, but the pro is it'll make our goods a little bit more competitive overseas. Narrow leadership. I'm going to talk about this little one for a brief minute. Last year, well, by a show of hands, if everybody's reads about the markets, I don't know if everybody does, but the Magnificent Seven, who heard about that last year? Raise your hand if you heard about it. It's okay if you didn't. All right, well, a handful. The Magnificent Seven, 7 stocks in the U.S. stock market drove 88% of the returns. If you didn't own those 7, you didn't make nearly as much money. And they were all tech stocks. I'm not going to list what they all are, but a bunch of big tech stocks. We expect that to differentiate, meaning more companies will actually go up this year instead of just a handful. We had negative investor sentiment. That was one reason why the market did go up last year. We call it climbing the wall of worry. When everybody's worried, that's a good time to be an investor. When everybody's euphoric, you know you're getting to the top. So when you have your family members start texting you about which next penny stock to buy, and they're dumping their monies into stocks you've never heard of, that's when you know the market's at a top. So I'm a big contrarian investor. It's worked for decades. We are, I will say this, starting to get to somewhat elevated levels of excitement about the market. I've had a few clients call in to kind of throw some extra money in. It's called FOMO, the fear of missing out. It's a very, very powerful emotion. Fear and greed drive the market. Once greed becomes the dominant factor, you know the market's likely to pull back. The one thing, the wild card, over to the left. The one thing everybody says, what's the black swan? The black swan is the event that you just don't know, can't predict, that tanks everything. Well, that's clearly the geopolitical uncertainty in the Middle East area. If the conflict widens, our analysts estimate, and that means like a direct, campaign in Iran or somewhere else, widening, meaning a big escalation. We predict oil would go to $150 to $200 a barrel. Currently, we're 80-ish. I didn't check the last few days, but we've been in the 75 to 85 range. What would that mean? Gas prices to $7 and $8. The Fed would be handcuffed. They could not cut rates. We'd be in a quagmire, and the economy would go into a recession. We only place the odds of that at 5 or 10%. So like I tell clients and my institutional people that I cover, you can't make bets on something that has only a 5 to 10% likelihood. So we go with the majority, which is 80% to 90% likelihood that things will actually be positive this year. Not as good as last year, so I'll spoil the parade there. There is some future concerns about the U.S. deficit, which are obvious. I think there'll be a day of reckoning. I don't think it's this year. That'll never happen in an election year. In fact, anecdotally, election years are usually positive 88% of the time. And when you combine that with the Fed cutting rates, the stock market has never been down when those two things have occurred concurrently. Everybody wants to know this. All right. What is the next move? We're at 2024 and beyond. I'm going to go down to the bottom. These are our base case. We call it the bull case. 20%, chance. That's the market keeps rolling like it is, like keeps going higher, defying expectations. There's a bunch of reasons for that, but again, for time purposes, this is an hour-long presentation that I'm condensing into 15 minutes, so keep that in mind. Scenario 2, the 50% probability is our base case. You know what? Earnings growth, nice. The dollar weakens, all the things I just talked about. We'll still be good. We'll not have a 20% return like last year, but maybe a 5 to 10%. I want you to notice one thing. That means 70% possibility is a positive one. So overall, there is a bear case, 20%. Earnings decline, harder landing, one that's not listed, but it relates to financial instability, mostly commercial and office real estate. You've already seen last year Silicon Valley Bank and First Republic being taken over. There's still a lot of exposure to these empty offices with a lot of debt that's coming due this year. That just means that either the banks are going to have to renegotiate or be a little bit more friendly on their covenants, because the banks don't want to repossess a building that's 50% empty either. We do think most of these things will be negotiated, but we do think there will still be some bank failures, smaller ones, regional, small local banks, actually, unfortunately, who are over leveraged. and some consolidation. So if that blows out of control, that is the bear case. That would be about a 10 to 15% decline in the market, by the way. And then we call our grizzly case, the grizzly bear case. Hard landing, huge emergency measures, that would be a 20 to 30% decline. And that's where we're putting that 10% case, which again, I'm not making bets on that. In most of these cases, in fact, 90% are either slightly negative to very positive. That's where we're putting our baskets, eggs in our baskets. And here's to that point. If you guys, I can nerd out on this stuff. I'm just going to look at it for a minute. This just says if you own a portfolio and you have all these various sectors, so on the left are the asset classes, on the right are the sectors of the economy. If I were an investor, or if you were my investors, by the way, these are the things that you would either own more of, kind of own what you got, that's what neutral means, or own a little less of, or a lot less of. So you look for the dark greens and the reds. There's none of those in
I lost you, Jason. You lost your audio.
classes. So for the most part, showing, which I think you can't hear me.
I can hear you now.
All right. Yeah, I'm just on the computer there. So occasionally there's a cutout. Oh, it's yelling at me that my connection is unstable. So warn me if you can't hear me again. So getting back to that, most things are either slightly overweight or slightly underweight or neutral, which means that if your portfolio is well balanced, you should probably keep it where it is. The right-hand column, for reasons I just explained, energy, we would own energy, more of what you typically would. We like healthcare, a couple different reasons, the aging demographics, obvious one, but also this explosion in these diabetes, really weight loss drugs is what they've converted them to, is going to create a significant tailwind for some of the bigger pharmaceutical companies who have these products. We expect sales to be in the 200 to 300 billion range over the next 10 to 20 years. I'm a little wary of that because there hasn't been a lot of long-term clinical studies over taking these for off-label use. That's a whole nother story. The only one, the real one that we're a little nervous of is consumer discretionary, and mostly because that's the stuff that I just talked about earlier. That's all the kids, and I have 3 boys. They're 17 to 24. My older 2 got stimulus checks. They spent a bunch of money. They blew a bunch of money on a bunch of crap. Well, that money's gone. So where this discretionary part of the consumer, we're negative on, if that makes sense. This is a recap. I'm not going to go into this at all, but if you were curious about what things did, fourth quarter was amazing. It was the best fourth quarter that I can remember, I think in over 30 years. In one quarter, things were up 10, 15%. You can see on the left, we're the highest growing. On the right, we're the least performing things, but there's only a couple of negatives on this old chart here, which is pretty phenomenal. Almost everything was up in the fourth quarter. All right, so just a brief thing here. Global themes and trends. It just explains how things work. Give me 1 second, I had something pop up. It shows you what we're in, and you can argue that we're either in the late or the recession, avoiding a recession. We're kind of around the last 2. Leading indicators, trends slightly lower, profits are beginning to peak, short interest rates are peaking. Housing, that was tough. That one did not happen. But you see what we would invest in those various cycles throughout the economy. This is what I referenced before, a handful of stocks. There's the Magnificent 7. This is awesome. It's 77% on this slide. I've heard a lot of numbers, but again, refer back to this. You own those 7 stocks, you had a 77% return. You own the other 493, you had 13%. That's pretty amazing. It's never been that concentrated before. So this is just a slide that points that out. Fixed income, for those of you who don't know, that just means bonds. Fixed income have been very tough. Like I said, historically, bad returns in the bond market the last 2 years. However, after peak cycles, you can see from the column with the blue and the red there, the longer term bonds vastly outperform the shorter term bonds and cash. So a lot of investors, and the reason I chose to keep this slide in here, it's hard to invest when cash pays 5%. I mean, it's tough, right? You're like, well, why would I put any money into bonds that are paying me 4.5 when I can get 5% guaranteed? Well, here's why. That 5% in money markets and short-term bonds is not going to last. In fact, it's going to go down to about 3.5%, maybe 3% by the end of the year. Still not 0. And that's the one thing I also want to point out is we got spoiled or punished, depending on what type of investor you were, since the Great Recession. Interest rates have been 0 for a long, long time. That is not normal. They're supposed to be about 3% on your cash. That's historical. It's supposed to, almost 2 to 3%, kind of keep up with inflation, maybe not quite. We've obviously got this spike. But what I will tell you is be careful of keeping too much money in the short-term cash. I think it's, it's going to hurt you in the long run. You should start shifting, if you do have bonds and fixed income, money into the longer, the 3-year, the 5-year, those type of investments. As you can clearly see, they've vastly outperformed after the Fed hike cycles have peaked, which we do think it's peaked. Well, I always like these charts. Oh, yeah. So we're going back to 1946. Blue, our expansions. Red, our recessions. Obviously very painful when they happen. But one thing I think everybody should notice is they're very short in nature. Going back to the worst one in history, which we all lived through, including me, is the financial crisis, Great Recession. We were down 56.8% in the S&P from its peak to its trough. Then we had a huge expansion. Then we had a little mini recession in 2018, which didn't even last 2 months. We had another mini recession during COVID in March of 2020, which lasted about 3 months. It was painful, very short. So all that's saying is be mindful when you're going through one of these downturns. They do recover, as you can clearly see. Obviously this doesn't go back as far as the Great Depression, but there's some pretty bad ones in here. There's the tech crash, there's the oil crash, there's a bunch of crashes in here. The Vietnam War pullback, they've all been followed by periods of expansion. So I always like to just point that out. And also notice the percentage returns on the periods of expansion are almost always greater. And there's never been a 10-year time frame, including if we go back to the Great Depression, if you were diversified, that you've lost money unless you sold. So just keep that in mind, just for people who tend to get nervous. That's why I include this slide.
Hey, Jason, we're approaching 30 minutes, so wrap up.
Got it. Thank you. So that I'm going to skip. You can look at this. It's a tactical guide thing this explains what happened during COVID. So I will stop there in case you do want any Q&A, Mike, or I can just stop there.
Well, let's see if there are any questions. Anybody have any questions for Jason? Go ahead and unmute yourself. Anybody have any questions?
We have a captive group.
Okay,
sounds like there's no questions.
Mike,
Go ahead, Dave.
Yeah, I think Jim Adsley was trying to say something. I think he's been muted off or something.
Looks like he's unmuted now. Jim, you want to ask a question?
He's still not.
He's not muted. I can see on the screen.
Jim Ashley is muted, if that's who we're talking about.
How about now?
There you go.
There you go.
I wanted to ask about the flap we're in with China. A lot of people want us to disconnect for a lot of reasons, but a lot of the corporate America is tied into China pretty deep. What kind of prospect would that hold for the stock market, which actually it seems like Wall Street is pretty pro-China?
Well, we as a firm are negative China and recommend almost no investments directly with China. And actually, there is a big decoupling already occurring. You can already see like companies like Taiwan Semiconductor are building a giant chip farm in Arizona. So, it depends on if that momentum continues. But we've seen a big decoupling from China, specifically post-COVID. And in fact, we had one of the lowest deficits for import-export to China that I've seen in my lifetime. So just the numbers are a lot bigger, but the percentage shift is shrinking. Again, it depends on a lot of different variables. It's a great question. I would say we are tending to unwind, just to answer that part of the question. And it depends on how many companies and how further they're entrenched are. I've already seen energy companies pulling out of various Chinese projects. So the headlines may seem like we're in knee deep, but I can tell you this, we're very wary of long-term relationships with China. We think they're going through some structural problems right now. And because of their lack of transparency on many different things, but mostly their financial markets, the Chinese stock market, in fact, was the lowest performing stock market of 2023. 98% of all stock markets were positive. Theirs was negative 20+% as a reflection of how the rest of the world sees them. So we'll see if that continues. And then they might have to make some change just to keep stability in the region. We'll see. Good question.
Thank you. Thank you.
Okay, thanks, everybody. We're going to have to cut off questions anyway because we got to move on. We're kind of getting a little bit long. Jason, it was wonderful. Thank you so much. Really appreciate it.
You're very welcome. And again, I appreciate all of what you do and did and et cetera. We're good. I'll talk to you, Mike.
Okay,
Thank
thanks.
you. Yeah.